All right, Chapter 9. What we're going to do is we're going to talk about the most common single factor risk model that is out there. It's the capital asset pricing model, or the CAPM. Most of you have heard about this. The CAPM is a very familiar model. Lots of folks use it. In fact, in practice, this is well used. Look at this. So this is a survey from a couple of financial economists. John Graham and Cam Harvey were at Duke at the time. I think they might both still be there. And what they do is they surveyed 392 CFOs about their cost of capital, capital budgeting, capital structure. Basically, they asked the CFOs, what method do they use to estimate the return required by shareholders? In other words, what method do these CFOs use to begin to think about what investors are going to require from them in terms of a return? Here are the results. So this is the percent of CFOs who always or almost always use a given method when estimating what we call the cost of equity, or you can think of that as the return required by shareholders. And look at this. Almost 75% of CFOs always or almost always use the CAPM. Okay? So what we're going to talk about is we're going to talk about the CAPM, and this is going to be super important, not just for this class, but it appears that folks outside in industry are using this widely as well. Don't lose sight of what we're going to do here. The CAPM, we're going to try to figure out, estimate what beta is, or the firm's exposure to the systematic risk. But we're also going to use the CAPM to estimate alpha. Recall in previous videos, we're going to try to come up with an asset pricing model where we completely identify all of the systematic risk that exists in the world, and that will allow us to isolate the alpha. Okay, that will allow us to isolate the performance of a particular portfolio while holding constant all of that systematic risk. Like all other models, the CAPM relies heavily upon some assumptions here. Let's talk about these. First assumption is that there are perfectly competitive markets. Here is a list of things that means. So under the assumption of perfect competition, firms sell identical products. That's not true in real life. Firms are price takers. That's sometimes true. Firms have small market value. That's sometimes true too, but there are other industries where you have kind of oligopolies controlling most of the market share. And there are no barriers to entry, which is also not true. So understand that the perfect competition assumption is important for us to derive the CAPM, but that might not be true in practice. Okay, we're only going to deal with one holding period. That is, this is not a dynamic model. We're only going to look at one holding period. We're only going to look at publicly traded assets. And then we're going to make some assumptions here that are a little bit troubling. One, there are no taxes. Okay, that's obviously not true. And if we relax that assumption, what effect would that have on the model? I don't think we're sure. There are no transaction costs, so investors don't have to pay any transaction costs. That is, the market is not only perfectly competitive, but it is also very liquid. All right, we'll talk about what happens when illiquidity is a part of the market. This is also an interesting one. Investors are mean variance optimizers. I've written up here the CFA utility function that we've talked about previously. Recall that the CFA utility function stops at the variance and doesn't account for skewness or kurtosis, which we've talked about previously. What happens when we allow investors to have preferences for skewness, or at least dispreferences for negative skewness, or let's say investors are loss averse? What effect does that have? And does the asset pricing model that we're going to use generate alpha strictly because of that assumption? That's possible. Last but not least, investors have homogeneous expectations. That is, investors have all the same expectations. Well, that's not true. Right now, the market is crazy volatile right now. The VIX is over 60, suggesting that nobody can decide, or nobody has the same expectations about what the price of stock should be. What happens when we relax that assumption and allow for heterogeneous expectations? Is there possible alpha associated with a strategy based on, say, heterogeneous expectations? So look, in order to solve the CAPM, we've made some assumptions, some pretty heavy assumptions about various things that probably aren't true in real life. When we go about relaxing those assumptions, can we find alpha using the CAPM or other factor models that we'll talk about a little bit later? Let me tell you what happens. So these are the implications of the CAPM. this is important to note. I'm basically giving you the punchline before we ever even start talking about it. All investors will hold the market portfolio. Okay, if investors have homogeneous expectations, that's probably understandable that investors are going to have the same behavior and end up with the same result. Okay, so in equilibrium, the CAPM suggests that all investors will hold the market portfolio, that this market portfolio will be the optimal or the efficient portfolio, or the portfolio on the most northwest quadrant in the efficient frontier in a Markowitz context. Okay, so said differently, if we believe the CAPM, then the efficient portfolio, remember what the efficient portfolio is. We're adjusting our weights. We're trying to optimize a portfolio by adjusting our weights. We're maximizing the ratio of the expected return to variance or standard deviation. And Markowitz says we should choose the efficient or the optimal portfolio in the most northwest quadrant. The CAPM suggests that the market portfolio is the optimal portfolio. In equilibrium, the expected return on the market minus the risk-free rate, this is called the market risk premium, is equal to the average individual's coefficient of risk aversion times the variance of the market. Okay, this is important. If you'll recall, in the previous module, Module 3, we came up with a way to measure the coefficient of risk aversion. If I solve algebraically for A bar, the average coefficient of risk aversion, I get the same formula that I came up in case 1 when we were defining optimal portfolios. And last but not least, and perhaps the reason why Bill Sharp, who wrote down the CAPM, won the Nobel Prize, is that the measure of systematic risk is equal to the ratio of the covariance of the returns for the particular asset in question and the returns in the market relative to the variance of the returns in the market. Now, some of you aren't fully understanding how nicely that result is. That there is the regression coefficient. If I regress the returns on the y-axis for a particular asset and the market returns on the x-axis, then the slope coefficient from that regression gives me beta. This is the firm's exposure to the systematic risk. Okay? So it's important to understand how this, what happens in equilibrium in the CAPM. We can estimate beta, the firm's exposure to systematic risk, and we can estimate it really easily using a regression equation. We know that the investors will hold the market portfolio, and that market portfolio is the optimal portfolio, and that the coefficient of risk aversion for the average investor is just equal to the market risk premium scaled by the return on the market, or I'm sorry, the variance of the market.